People are going to hate me for saying this, but saving money is probably the worst financial advice you can follow. And I know that sounds insane. Your parents told you to save. Every financial advisor tells you to save. Dave Ramsey built an empire telling people to save, but they're all wrong. Or at least they're incomplete. Let me explain what I mean. Saving money made sense in 1950. It made sense when interest rates were 6% and inflation was 2%. You could actually put money in a bank and watch it grow in real terms. That world doesn't exist anymore. We live in a world where your savings account pays you 0.5% and inflation is running at 4%, 5%, maybe 8%, depending on who's counting. You're not saving, you're losing. Every dollar you keep in a savings account is a dollar that's actively getting weaker. It's like trying to hold water in your hands. The harder you squeeze, the more leaks out. And yet people treat their savings account like it's some kind of virtue. I've got 50,000 in savings. Congratulations. You got $50,000, that'll be worth 45,000 in real terms next year. Here's what they should be telling you. Don't save money, deploy it, put it to work, make it do something, because sitting money is dying money. I learned this the hard way. When I sold Zip2, I had about $22 million. For about 3 seconds, I thought maybe I should just put this in bonds and live off the interest. Then I did the math. Even at a decent interest rate, I'd be making maybe $1 million a year. Sounds good, right? Except inflation would eat half of that. And I'd be sitting around doing nothing while my capital slowly eroded. So instead, I put it all into X.com, which became PayPal. High risk? Absolutely. Could I have lost everything? Yes. But here's the thing. If I'd played it safe, I'd have been guaranteed to lose through inflation and opportunity cost. By taking the risk, I had a chance at exponential returns. And that's exactly what happened. Now, people hear this and they think I'm advocating recklessness. I'm not. What I'm saying is that the real risk isn't taking chances with your capital. The real risk is doing nothing. Letting it sit, letting inflation and time destroy its value while you pat yourself on the back for being responsible. You know, what's responsible? Understanding that we live in an inflationary system, understanding that governments print money, understanding that the purchasing power of a dollar in 2025 will be less than the purchasing power of a dollar in 2024. That's not a conspiracy theory. That's just how the system works. So if you're saving dollars, you're saving something that's designed to lose value. I see this all the time with people who are nearing the end of their working years. They've got 100,000, 200,000 sitting in a savings account. They think they're being prudent. Meanwhile, that money is losing 4% of its value every year. In 20 years, their 200,000 will have the purchasing power of about 100,000. They work their whole lives to accumulate capital, and they're letting the system quietly confiscate it. Here's what you should be doing instead. Investing. And I don't mean giving your money to some advisor who will put it in a target date fund and charge you fees. I mean actually investing it in things that produce returns greater than inflation, real estate that generates rental income, stocks in companies that are growing, index funds that track the market, even starting a small business, anything that has a return above inflation. Let me tell you about a guy I know. Spent his whole career as an accountant, made decent money, saved religiously, had $400,000 in savings by the time he was 60, felt great about himself. Then he retired, and he realized that $400,000, even if he's extremely careful, gives him maybe $20,000 a year to live on if he doesn't want to run out. That's not wealth. That's poverty with a savings account. Compare that to another guy I know, made about the same money, but instead of saving, he bought 3 rental properties over his career. Nothing fancy, just modest houses in decent neighborhoods. By the time he retired, those properties were paid off and generating about $60,000 a year in rental income, plus they'd appreciated in value. He's actually wealthy. The first guy just saved himself into mediocrity. The difference? One guy understood that money's a tool, the other guy thought money was a trophy to be preserved. And that's the fundamental mistake most people make. They think the goal is to accumulate dollars. It's not. The goal is to accumulate assets that produce income or appreciate in value. Now, I can already hear the objections. But Elon, what about emergency funds? What about liquidity? What about safety? Fair questions. Yes, you need some cash. You need enough to cover 6 months of expenses, maybe a year if you're paranoid. That's your buffer against disaster. Everything else, put it to work. And and here's the thing about safety. People think a savings account is safe. It's not. It's guaranteed to lose value. What's actually safe is owning assets that have intrinsic value. A piece of real estate, a share in a profitable company, a skill that generates income, these things can't be inflated away. A dollar can. I think about this a lot because I see people making the same mistakes my parents' generation made. They worked hard, saved diligently, and ended up with a pile of cash that bought less and less every year. Then they blamed themselves for not saving more. But saving more wouldn't have solved the problem. The problem was the strategy. Here's another way to think about it. Imagine you're on a sinking ship. The boat is going down, slowly but surely. You can either stay on the boat because it feels safe and familiar, or you can get in a lifeboat and start rowing. The savings account is the sinking ship. It feels safe because you're not moving. But, but you're going down. Investing is the lifeboat. It's scary because you're out on the open water, but at least you've got a chance. When I started SpaceX, I put $100 million into it. People thought I was insane. You're going to lose everything. Maybe. But keeping that 100 million in cash would have been a guaranteed loss through inflation and opportunity cost. By putting it into SpaceX, I gave myself a chance at creating something worth far more. And even if it had failed, I'd have learned something valuable. Cash sitting in a bank teaches you nothing. Let me give you a more practical example. Let's say you're sitting on $50,000. You're proud of it. You saved for years. Now what? If you leave it in savings, in 10 years, it'll be worth maybe 40,000 in today's dollars. Congratulations, you lost $10,000 by doing nothing. Or you could take that 50,000 and put it into an S&P 500 index fund. Historically, the market returns about 10% annually, some years more, some years less. But over 10 years, your 50,000 becomes about 130,000. Even after inflation, you're way ahead. You didn't do anything clever. You just put your money where it could grow instead of letting it rot. And if you want to be more aggressive, you could use that 50,000 as a down payment on a rental property. Let's say you buy a $200,000 property with 20% down, you rent it out. The rent covers the mortgage. In 10 years, you own an asset worth maybe 300,000, and you've been collecting positive cash flow the whole time. That 50,000 turned into wealth, not by saving it, by deploying it. Now, some people are going to say, well, what about risk? What if the market crashes? What if the property doesn't rent? Valid concerns. But here's what nobody tells you. Not taking risks is also risky. Sitting on cash while inflation eats it is a risk. Not learning how to invest is a risk. Being dependent on a system that's designed to devalue your savings is a risk. You're not avoiding risk by saving. You're just choosing a different, slower form of destruction. I learned this from watching my father. He was an engineer, smart guy, made good money, and he saved most of it, kept it in bonds and savings accounts because he didn't trust the stock market. By the time he was older, that pile of savings was worth a fraction of what it should have been. Not because he spent it, because he protected it to death. He was so afraid of losing money that he guaranteed he'd lose money. I didn't want to make that mistake. So when I had capital, I put it to work immediately. Zip2 money into PayPal, PayPal money into SpaceX and Tesla, SpaceX and Tesla money into more ventures. Always moving, always deploying, never sitting still. And yeah, I've had failures, plenty of them, but the wins have been so asymmetric that the failures don't matter. That's another thing about investing versus saving. Saving has symmetric outcomes. You keep what you have minus inflation. Investing has asymmetric outcomes. You might lose some, but you might make 10 times, 100 times your initial capital. The upside is unlimited. The downside is limited to what you put in. That's the trade you want to make. Here's what I wish someone had told me when I was younger. Money is energy. It's potential. When you save it, you're freezing that potential. When you invest it, you're releasing that potential into the world. And the world rewards people who put energy into motion. It punishes people who hoard it. Think about it this way. If everyone just saved their money and never invested it, the economy would collapse. There'd be no new businesses, no innovation, no growth. The system depends on people taking capital and putting it to productive use. And the people who do that are rewarded with returns. The people who don't are quietly taxed through inflation. I'm not saying you should gamble your life savings on cryptocurrency or some get-rich-quick scheme, that's not investing. That's speculation. What I'm saying is, take your capital and put it into assets that have a track record of producing returns. Real businesses, real assets, things that generate cash flow or appreciate over time. And if you don't know how to do that, learn. That's the other problem with the just save money advice. It encourages financial literacy. It tells people, just put your money in a bank and don't think about it. That's a recipe for poverty. What you should be doing is learning how money works, learning how investments work, learning how to evaluate risk and return. That knowledge is worth more than any amount of savings. I spent years learning about business, about markets, about what makes companies valuable. That education paid off 1,000 times more than if I just saved every dollar I ever made. Because once you understand how capital works, you can deploy it intelligently. You can see opportunities that other people miss. You can avoid traps that other people fall into. Yeah, here's a specific example. In 2008, during the financial crisis, real estate prices crashed. People who had cash sitting on the sidelines were able to buy properties at 50 cents on the dollar. 10 years later, those properties had tripled in value. The people who were safely sitting in savings accounts missed the opportunity of a lifetime. The people who understood that crashes create opportunities got rich. That's what deploying capital is about. It's about being ready when opportunities appear. And opportunities always appear. They just don't show up with a neon sign. You have to be paying attention. You have to have capital ready to deploy, and you have to have the stomach to act when everyone else is scared. Most people do the opposite. They invest when things are going well and everyone's excited, then they panic and sell when things crash. That's backwards. You should be buying when people are scared and selling when people are greedy. But you can't do that if all your money is sitting in a savings account earning nothing. Let me tell you what happened in 2008. Tesla was on the brink. SpaceX was failing. I was out of cash. I had to choose which company to save. It was the worst period of my life. But you know what? I learned more in that 1 year than in the previous 10. I learned about resilience. I learned about capital allocation under pressure. I learned that having your money in motion means sometimes you nearly lose it all, but sitting still means you definitely lose it slowly. We got through it, and the lessons from that period shaped everything I've done since. If I'd been sitting on a pile of safe savings, I'd never have learned those lessons. I'd have been comfortable and ignorant. Instead, I was terrified and educated. Here's the bottom line. Saving money is not a strategy. It's what you do when you don't have a strategy. If you're saving because you're preparing to invest, great. That's smart. You're accumulating dry powder. But if you're saving just to save, if your goal is to have a big number in a bank account, you're making a mistake. The goal should be to convert your earned income into assets that produce passive income or appreciate in value. That's how you build wealth. That's how you protect yourself from inflation. That's how you create freedom. Saving is just the first step. Deploying is where the magic happens. And for people who are later in their journey, who maybe spent decades saving, it's not too late to change course. Take that capital you've accumulated and put it to work. You don't need to take huge risks. You don't need to start a rocket company. Just move it from assets that are guaranteed to lose value to assets that have a chance to grow. Buy dividend-paying stocks, buy an index fund, buy real estate, start a small business doing something, Do literally anything except let it sit in a bank account earning nothing while inflation eats it alive. Because here's the truth they won't tell you. The financial system is set up to transfer wealth from savers to investors. The government prints money, which devalues savings. That money flows into assets, which increases their value. The savers get poorer, the investors get richer. That's not a bug, that's a feature. So if you want to win at this game, you have to play by the actual rules, not the rules you wish existed. And the actual rules say money in motion wins, money standing still loses. That's why saving money is the worst financial advice. Not because saving is bad, but because stopping at saving is financial suicide. Deploy your capital, put it to work, give it a job. That's how you build wealth. That's how you beat inflation. That's how you win. Everything else is just slow motion poverty with a savings account attached.